Thank you all so much for coming today. Really, it's a real pleasure to be in front of you this afternoon. The launch of the new Finance and Democracy Initiative here at BESI/Matrix. So I wanted to say, just introduce what is this initiative, what are we doing, why are we here, introduce the people involved, and then introduce our wonderful speaker for this afternoon. So the intellectual motivation is that democracy and finance, once mutually accommodating to some degree, now threaten to permanently part ways. That wealth accumulation through asset price appreciation rather than economic growth has decoupled elite fortunes from shared prosperity. And monetary policy has accelerated this divide, raising fundamental questions about democratic legitimacy. Meanwhile, the rise of things like cryptocurrency has created new forms of concentrated financial power, and the digitization of financial infrastructure from algorithmic trading to digital payment systems is reshaping monetary sovereignty itself. So our mission is to catalyze critical scholarship that examines how finance drives inequality and explores democratic alternatives. And our goal is to produce original research, convene scholars across disciplines, and support emerging researchers. So our steering committee has 3 people. So myself, I'm Brian Judge. I did my PhD here in political science, and I'm now the program director of this new initiative. So we have Mariam Fourcade, who's the Natalie Cohen Professor of Sociology and the director of the Social Sciences Matrix. Paul Pearson, the director of the Berkeley Economy and Society Initiative, and the John Gross Distinguished Professor of Political Science at UC Berkeley. And Paul is also the co-director of the Consortium on American Political Economy. And Bob Meister, who is the professor in the history of consciousness at the UC Santa Cruz and a visiting professor of political science at the University of Chicago. I also just want to thank the BESI and Matrix staff, without whom none of this would be possible. So Sarah, Eva, Amanda, and Aaron, just really want to give them thanks for supporting the launch of this new initiative. Could not do it without them. Also want to point out that we have a visitor, Fabienne Muniesa is here from Paris, who will be giving a talk on Thursday on finance and fascism, so stay tuned for that. So now I have the great pleasure of introducing our speaker for today. And indeed, I don't think there is a better person to launch a new initiative on finance and democracy than Professor Michael McCarthy, who's Associate Professor of Sociology and the Director of Community Studies at UC Santa Cruz. So his first book, Dismantling Solidarity, Capitalist Politics and American Pensions Since the New Deal, was published with Cornell University Press in 2017. His most recent book, The Master's Tools, How Finance Wrecked Democracy and a Radical Plan to Rebuild It, was published by Verso last year. And so in addition to academic publishing, his work has been featured in the Boston Review, The Guardian, Hammer and Hope, Jacobin, The New York Times, The New Left Review, and The Washington Post, and is currently writing about class and political identity. And so what we're going to get today, I hope, is a development of a political and social theory of emancipatory change rooted in the interconnectedness of finance and democracy, and give us a view of how democracy and working class power can be strengthened by creating new deliberative forms of financial governance. And so without further ado, please join me in welcoming Professor Michael McCarthy.
Thank you so much for that introduction. And truly, I'm sure there are other people that are much better than me to do the inaugural. But I truly appreciate being invited here and being given the chance to share my work. So thank you for that, and I'm really looking forward to seeing all the interesting things that come out of the new initiative. Okay. All right. I'll just dive into it. Let's start with a possible future for the Bay Area. We're going to start with something a little cutesy. Imagine that finance were to suffer something of a democratic rupture, and you find yourself living through its effects. It's a sunny Friday morning in the year 2045, and you're running late for a meeting. A new democratic process for allocating funds has completely transformed the Bay Area. You step off the train in the public finance district. The streets here were converted into pedestrian zones after huge investments in transportation, essentially eliminated the need for cars. Homelessness has nearly vanished, and the cleanliness of the sidewalks would have come as a shock 20 years ago. Gone are the days when people lived in tents with nowhere else to go or slept alone, flat on the crusted concrete. Instead, a public bank has allocated finance into housing and health projects that have gone a long way towards solving the problems of the worst off. Today, you will participate in the process that help these changes come about. You pull out your phone to check the messages. We're still using phones in 2045, by the way. The message says, Assembly duty notification. You've been selected at random to participate in the People's Assembly for the Public Bank of San Francisco in its Green Planetary Futures Division. Your role will be on the Standing Commission of Workers to ensure the needs of the workers of San Francisco are met. The Assembly will make decisions about financing that will determine what green public goods our city will invest in the next 4 years. Your voice, deliberation, and judgment are essential. Now, of course, that's complete utopian fantasy, but just hold it in your brain for a bit, because that's where we're going to end this talk, in complete utopian fantasy. I remember when I was living in New York in 2011, kind of throwing myself into the Occupy Wall Street movement, which kind of emerged in that year. By 2012, Occupy Wall Street had kind of reinvigorated campus activism across the US. There were occupations of campus spaces which spread like wildfire, much like some of the occupations that happened a few years ago here in relation to Gaza. And off-campus, students became involved in solidarity work with labor and different types of community activists, including housing activists. And yet, if you look back to the Occupy Wall Street moment, the activism was primarily defensive. It was against privatization. It was against money in politics. It was against tax dodging, tuition hikes, evictions, unions being dismantled, et cetera. Today, however, financial activism has kind of undergone a more emancipatory transformation. Organizations like Cooperation Jackson, which is located in Mississippi, or Public Bank LA, which obviously in LA, or the San Francisco Public Banking Coalition, just across the way, have really shifted towards looking towards much more bold and democratic solutions to the problems of finance. We have a mix of scholars and think tanks, left politicians, grassroots activists, are all truly trying to work through to kind of reimagine what finance might look like in the future. And a wide range of alternative institutions and experiments are in the works. Sovereign wealth funds, inclusive ownership funds, different forms of sharing economy like are happening in Cooperation Jackson, democratizing things like pension funds, green banks, democratic public banks, and so on. We've moved from a defensive kinds of financial activism to an emancipatory one. And today my talk is really both about what these activists are responding to, but also about the kinds of visions that they're looking towards the future. That's all by way of just setting up the basic kind of format of the talk today. To get there, I'm going to try to go through three basic points. The first, I want to talk a little bit about why finance is a democracy problem. Why this isn't just something that we should leave to economists, although economists are okay if there's some in the room. The second is I want to talk about how finance actually wrecks democracy itself, how it undermines democratic processes and undermines the ambition of democratic representation in the state. And then the third, this is kind of like the positive. The first two parts are negative, the sad parts. The third is the positive. The third is basically thinking about the ways that current contemporary financial activism points us to an alternative. And I want to think through three different principles for democratizing finance, and then show you a plan for democratizing finance, which I'm sure you're going to have lots of criticisms of. Okay, so that's the plan. Why is finance a democracy problem? Okay, here's the familiar story. You all know this. The familiar story goes something like this. Financialization is a regime of accumulation in which profits increasingly accrue through financial channels, things like interest, dividends, capital gains. And the story of financialization is really a story of advanced capitalist countries finance taking an increasing share of total GDP. And that's basically what this shows in the US, right? Finance, insurance, real estate, kind of increasing as a share of GDP. This is the familiar story. We all know this. What a lot of my work tries to show is that financialization is not simply about firm profits or the growing role of financial mechanisms in generating profits. It's also that the income-producing assets of the working class itself is increasingly financialized. It's also a story about how wealth of ordinary people becomes financialized. So not just profits, but actually financialization has drastically transformed the nature of wealth for both the elite and ordinary workers. So this is from the Federal Reserve, flow of funds. Some calculations I did. Here's the top 1%. These are basically financial assets as a share of total assets of the income groups. The black stock and mutual funds, the gray pension savings. And comparing 1989 to 2019, you can see that the elite have had a tremendous increase in their wealth and financial assets, right? So the top 1%, 59% increase in financial. But we also see that at the bottom, right? There's also, it's not as drastic, but it nonetheless also happens there as well, right? Working class people also have an increased share of their wealth in financial assets. Now, what's the upshot of all this in institutional terms? Well, the upshot of all this is as I wrote in my first book here, we've literally turned labor into capital through workers' savings and investments. It's led to what Ben Braun describes as a asset manager capitalism, and in a book edited by Paul Pearson right over there. It is ended up in what Brett Christophers calls asset manager society. So we have these large asset managers who are managing the wealth of the vast majority of people. In short, more and more people's personal wealth are run by asset managers such as pension funds, mutual funds, hedge funds, and increasingly private equity firms. And this means that they play a growing role in shaping total investment decisions in the US. Is that a
question? So where else would the wealth be not from financial assets? In a home or?
Sure, yeah, or just like in your savings account in cash. Yeah, it could be like physical assets, but yeah, I'm talking about yeah. Is that clear? Okay. Okay, so this means that basically these asset managers are playing a growing role in shaping total investment decisions. But because these institutions are organized to maximize their own returns above all else, they're driven by a logic of acquire and extract. They acquire assets to extract as much value as they possibly can out of them. Now, why does this matter? We're trying to get to why finance is a democracy problem. This shift has led to a systematic underinvestment in socially needed goods and services. A systematic underinvestment in things like housing. This is a picture from Santa Cruz where I live, where the housing market is absolutely insane. A systematic underinvestment in green retrofits and green infrastructure, and so on and so forth. A systematic underinvestment in the things that we socially need. The problem is, and this is trying to get the main point here. The problem is that the way our current system of allocating financial investment is set up, there's no way to incorporate social values into those investment decisions because workers' finance and indeed wealth in general is allocated through organizations that are set up principally for maximizing profit returns. There's no way to incorporate other values, right? Maybe people are concerned about the green impacts of their investing. Maybe people aren't concerned about housing in the markets or that they live in, and so on and so forth. Those types of values don't get incorporated in any way. And so this is why essentially finance is also a democracy problem, right? How do you construct financial organizations that can incorporate other values into asset allocation? That's the problem that I'm going to try to talk about. My book, The Master's Tools, really develops a framework to describe and theorize how. But I want to take a bit of a sidestep to lay out the conceptual problem that I'm trying to solve. In particular, oh, I'm sorry, I skipped something. It doesn't matter. What I'm trying to understand is, one, why is finance a democracy problem? But also, two, how has finance undermined formal democratic institutions like the state? And to get at this, I think we need to start with some of the ways that classic critics of pluralism in critical social theory have come at this problem. And here I have people like Charles Lindblom, Nikos Poulantzas, our very own Fred Block in mind. It's these individuals who really rightly identified capitalist control of productive assets as the fundamental basis of their political power. Without that control, capitalists would not have the resources to push their way through the chess game of capitalist democracy. But these theorists limit their analysis to an abstract level, leaving capital as a kind of stylized category. In this abstract view, we can't really tell how the specific character of capitalist power has changed over time, or why finance wields power differently than, say, manufacturing capital or agricultural capital. To understand the political power of finance capital, we need to move from this kind of abstract view of capitalists to a more conjunctural view, to examine power not as some kind of transhistorical feature of capitalism, but actually as something that's constituted by the specific institutional arrangements of society at a particular time. And this is where I get into essentially my concept of what I like to call asset power. And here's the core idea. The political power of finance doesn't just derive from the fact that they own productive assets. It derives from the character of the assets that they actually control. In the case of financial assets, what stands out is their mobility and their liquidity. Mobility being the ease with which an asset can be relocated across political territories. Liquidity being the ease with which an asset can be converted into cash. When assets become more mobile and liquid, as they have under finance capitalism, capital doesn't need to fight. It can simply flee, right? And just to give you a little bit of a historical illustration of this, Francois Mitterrand's France is probably the paradigmatic case. When his socialist government pursued redistribution, international investors exited French markets, collapsed the franc, and killed the socialist experiment indirectly. By contrast, when income-producing assets are relatively fixed and illiquid, such in things like land, mines, heavy industry, large-scale agriculture, capital cannot easily flee democratic demands. Violence in these cases is often the last resort. Think of the Southern plantation class prior to the Civil War, or the land and mine owners under Allende in Chile. Their assets were in the ground, so the resistance turned bloody, right? It turned into a coup. This is what makes our American moment today actually distinctive. The income-producing assets, increasingly, at the center of accumulation are overwhelmingly financial: stocks, bonds, derivatives, fund shares, and so on. Representing workers, a pension manager can, at the click of a button, sell billions of dollars in equities in milliseconds. And here's the crucial twist I'm trying to get at here. Many of these assets are not even owned by the capitalists who control them. They're the retirement savings of workers. They're managed by asset managers like BlackRock, Vanguard, State Street, and so on. But ownership does not equal control, right? The people that own these assets as their personal savings aren't actually controlling how they're being invested. The political power of finance actually derives from its management of the assets of the working people in society as a whole. So this asset power of finance lies at the core, I think, of how finance has eroded democracy. And I want to talk through three different ways it's done this, just to kind of make this maybe a little more concrete. The first way is what I call engagement. It's essentially the way that financial actors directly influence politics. It involves coordination across the financial sector, massive amount of money in politics, a huge amount of spending. The financial sector is the largest spender in election cycles and so on. It involves the interlocking directorates and business associations that tie finance together. And in this massive engagement in politics, lobbying, campaign finance, et cetera, we always come back to a common threat on the part of financial actors, which is disinvestment, right? I mean, read the Financial Times, it's like the one thing that they're always talking about. And it's something that they could do precisely because they control assets that are highly mobile and liquid, right? That gives them their political power. The second way I want to talk about is what I call entanglement. And this concerns the way that finance is embedded essentially in non-financial firms. Think first about small and medium-sized corporations in the US. We have a massive number of firms that are described as zombie firms, which are essentially highly indebted, and they're basically consuming debt to service their own debt. And well over half of the $14 trillion in corporate debt in the US is held in tradable financial assets, such as bonds or securitized collateral loan obligations. And this matters for what I'm calling asset power. When asset managers sell off bonds and CLOs, it floods the market with supply, drives down the price of bond. Because bond prices and yields are moving inversely, falling prices means higher effective interest rates for firms. Put simply, asset managers have the power to drastically increase the cost of debt for firms. When debt is turned into a tradable asset, the people who hold it on financial markets can leave at a click of a button. And when they leave, borrowing costs spikes, firms lay off workers, and governments lose revenue. This happened in the context of the Great Depression, the Great Bond Massacre of 1994, the dot-com crisis, the 2008 financial crisis, the COVID crisis, which caused the Fed, right, to step in to buy bonds directly. And I should say nobody understands what I'm talking about more than Robert Meister, who's talked about this extensively in his own work. So we see that finance here is completely entangled through debt, through small and medium-sized firms. But large firms on the other side of the story, many traditional, what we would think of as manufacturing or other types of firms, have growing subsidiaries that engage in lending, investment through financial markets. Think about the last time you were on a American Airlines flight or a Delta flight or whatever the case might have been, and you have offered a credit card, right? That's because they're acquiring a certain portion of their assets through also through debt relations. So how does this matter politically, right? How does this erode politics? Well, some interesting research by two political scientists, Stefano Pagliari and Kevin Young, basically shows that when regulators turn their sights onto finance, in terms of passing different regulation, no sector of business is defended by other sectors of business in finance. No sector of business is defended by other sectors more than finance in lobbying efforts, right? Put it a slightly other way, when a regulation comes down, it's aimed at finance. Other sectors of business come in to defend finance, right? Because their interests are intrinsically intertwined with the interests of finance, which makes finance, and to use an old, Marxist concept, somewhat hegemonic in our political moment, right? I would say it's not the tech firms. And the third way in which this asset power gets manifested is what I call prominence, what political sociologists and political scientists often term structural power. This refers to finance's position in the economy and how that position bears on the decision of policymakers when they're thinking about passing different types of bills or laws. Because financial assets are made up, because financial assets make up a growing portion of income-producing assets, this increases the number of ordinary people that are dependent on finance, right? That see their own interest as intertwined and tied up with how the stock market's doing. Even if it's somebody who owns a couple stocks on Robinhood app, all right, their subjective sense of their own interests become tied up in the stock market in some sense. And so in a way, people's economic well-being increasingly depends on the well-being of finance itself. Again, directly bearing on the state and what the state does, right? Politicians are less likely to pass laws that hurt the stock market if they think that their constituencies are going to get pissed off because of that, which their constituencies probably will get pissed off because of that. Here's the upshot of what I'm trying to get at. Today, asset power is exercised by those that control the investment of financial assets, even when they themselves don't own the assets. Again, I want to emphasize this. Ownership does not equal control in finance capitalism. And this asset power is key to understanding new emergent forms of politics and also contentious politics. When investors pulled their money in mass from different ESG funds in 2024, it was an explicit response to anti-environmental Republican campaigning, right? And these issues remain unsettled. If you read the financial news, we can see that pension funds in the Netherlands are withdrawing their money from different large asset managers in the US, precisely because there's been a rightward shift on environmental investing. This image is one I took. I was at a planning conference at the University of Chicago in 2024 in the summer. And in the middle of the conference, we heard a huge crash. And we walked out, there was like a little balcony. And students were occupying the building, like right next to us, breaking through the doors. And the building was housed to an institute that David Axelrod runs. But the purpose was to challenge the university to reallocate its endowment away from corporations that were directly profiting from the war in Gaza, right? The allocation, the question of financial allocation becomes an issue of contentious politics in our moment, right? It becomes an issue of contention between groups of people. Clashing values, right? Clashing values about how the values upon which we allocate our finance, right? Contentious politics becomes the avenue for alternative values to be expressed when there is not a democratic context for those values to emerge, right? That's the problem. That is the key problem. Okay, I've been focusing on nothing but negative things. Now for the positive part of the talk, which I'm sure all of you will criticize vehemently. Here's the problem. The only way to incorporate social values into investment decisions is to subject those investment decisions to some form of democratic control. There's no way around it. Because so many of these funds that we've been talking about are collective funds, it actually raises the problem of how do you create space for collective voice, for a shared perspective of the people who are bought into these funds. How do you create space for these individuals to actually have a conversation? And this is basically where I want to turn to now. Democracy as the solution. Okay. This is the fundamental insight of financial activists and different progressive policymakers today. To respond to the different predations of finance, the way it extracts as much value as it can and leaves things behind in in a terrible wake. Democracy needs to be extended to the economy. We need to start to think of the economy, as Carol Pateman once did, as part of the political, right? Not as separate from the political. And we see, if we look around at what financial activists are doing, this is precisely what they're doing, right? Whether it's Public Bank LA, whether it's different think tanks like Democracy Collaborative or Democracy Next, which is a European-based one. They're trying to think about new ways that we can extend democratic processes into the economic sphere, which for so long has been seen as a separate sphere, right, from the political. But how? How should we do this? How should we conceptualize democratic control in concrete terms? Because one would say the state is already a financial democracy, right? If what I've just described suggests that actually formal state politics are already basically shaped and run by financial interest, representative democracy can't be the answer. Like, just standard representative democracy can't be the answer. It has to be something else if the state itself is already a financial democracy, which is what I'm arguing. So if representative democracy isn't really the sole solution, what could be the solution? And this is where I want to turn to basically 3 different design principles that have kind of gotten out of some of the different organizing, but also different bills that have been put forward, such as Rashida Tlaib's 2023-2024 Public Banking Act. All right, three design principles. Now we're moving to the realm of pure theory. 3 different design principles. If democracy should be, if finance should be democratized, who should be the ones who have a say? Who should be the ones that are incorporated into democratic financial processes? And here, one thing that I see as I've worked with Public Bank LA a little bit and have seen the work coming out of Tlaib on the Public Bank Act, is that the people who should have a say about how finance is allocated should be the ones who are actually whose interests are actually most affected by it, right? If we have a pool of finance, whose interests are actually being affected by how that pool of finance works? And that's the first overarching principle, is the affected interest principle. And this is a very intuitive democratic idea. It's a very intuitive democratic idea. It's a solution in some ways to the problem of negative externalities, where costs are imposed on parties who don't have any say in transactions. On the screen, these are smokestacks, as is obvious. We Energies, it's located in Milwaukee, Wisconsin, which is where I lived for a while. These smokestacks divide the Black community from the Latino community. Historically, they were run with coal through We Energies, which is the utility company. And historically, both populations organized to try to get them to convert to clean energy. For decades, were unsuccessful. There was no systematic place for the voice of the community in sort of how We Energies ran. And those outside forces trying to convert it had to engage in social movement protest activity in order to get their voice heard, right? Eventually, it was converted, and now there's basically an organizing drive called Power to the People, which is trying to convert We Energies into a public utility. So, would it have been converted had there been systematic voice from the community on the governance of the board earlier? My suspicion is yes, right? My suspicion is yes. So who should have a say? Who should be the people that are incorporated in? Well, it should be the people that this fund is actually bearing on in some meaningful way. All right, that's the first principle. Here's the second principle. Does anybody know what this is, by the way? Anybody seen this? One of my friends said it looks like something you'd see in a spa. Dylan. Oh. Yes, it's called a clariterion. And it's this device that they used in ancient Athens to basically, do all sorts of random selections. And they would, it's like they would randomly select for all sorts of things. It wasn't just like the juries. We're talking about like the people who were cleaning up the temples after they had those rowdy festivals and stuff. They like randomly selected the people who would maintain market prices, so you can make sure that your harpist isn't overcharging you for when you hire her to come to your party. They had people who were maintaining sort of like the roads. They were randomly selected, like during a period of radical democracy. It was a couple hundred years. They were using these devices to do all sorts of random selection. And the second principle I want to focus on is random selection. And there are some really good reasons why this is a good way to select from that group of people whose interests are being affected by the pool of finance that we want to think about democratizing. Random selection overcomes some big problems that we have in democracy. Big problems. One is scalability. If typically when we think about an alternative to representative democracy, you'll actually get things like Occupy Wall Street, which are a form of direct democracy. Anybody who wants to participate simply can show up, right? This is useful for small scale things, but you start to run into some real problems as you try to scale that up to like larger groups of people, right? There's a certain point in which the size of the participant body it is actually harmful. As somebody who participated in Occupy Wall Street, I can almost certainly say it was not democratic. It was almost certainly being driven by a small handful of people who are behind the scenes trying to make things happen, right? And so you need to figure out some way of selecting people in to actually participate in deliberation, and random selection turns out to be quite efficient at that. There's also epistemic reasons. When you randomly draw people together to participate in debate, deliberation about something, it actually reduces their top of mind bias and how they think about things, right? Quite unlike a poll. If you go and poll people, right? The people, their bias will drive what their response is. But when you draw people together, you put them in a room with people that they don't know, just randomly selected group of people, kind of like them, kind of from different walks of life. They will, through discussion, actually see things in new ways. And it kind of brings to fore like better judgments, better political judgments, better ways of thinking, better ways of understanding an issue. The other really important thing about a random selection is a little something called cognitive divisions of labor. Currently, the way our representative democracy works is that we vote for somebody who we think has all the positions that we like, or maybe some mixture of the positions. But as individual voters, there's a certain expectation that we have full knowledge of all the relevant things, right? That we have, when we go to vote, we're informed voters. We have full knowledge of what we're voting about and all the kind of policy issues. But that's obviously completely ludicrous, right? Most of us don't know the first thing about all sorts of things. And yet we're expected to participate in something where the assumption is we kind of do, right? The reality is that we all can't know what's best for everything. This is oftentimes very hard for academics to hear. We all can't know what's best for every single thing, right? We need certain cognitive divisions of labor where certain people are given space to become expert in certain areas and to then make judgments about those areas on our behalf. And that's what lot can do, right? It can create a situation where people are brought together to talk about the Public Bank of LA or something, and I'm not, I wasn't selected, so I don't have to have that conversation. I can go play baseball in the park or something. And they develop the expertise, they develop the kind of connections and perspective to make judgment on our behalf. Aristotle once said, democracy is ruling and being ruled in turn, and that's kind of the idea here, right? That random selection can draw people into governing bodies to work for certain periods of time. Then their period's up, just like jury duty or something like that, and then maybe I'm selected, or maybe somebody else is selected next time. So it creates these cognitive divisions of labor. It also has anti-oligarchic effects. There's been some interesting work which shows that randomly selected groups of people who come together, these from all different walks of life, make political judgments, are actually seen with significant legitimacy by the greater population. Right? There's the judgments that they make are seen with greater legitimacy. And we've had some kind of experimental social science that tries to get at this, where you give people different messages from different sources. So let's say your local chamber of commerce thinks X. The local unions think X. Your local political leaders think X. These are all different sources. And then one says, a randomly group of people were brought together and they think X. That randomly selected group of people is seen as having kind of greater democratic legitimacy in their judgments, because they're not actually seen as having an interest, right? They're not seen as, in a sense of some biased interest. So they have greater legitimacy. They have the ability to generate equality and fairness, and also therefore democratic outputs. So we have this tool. It's an ancient tool. It's we don't have to use that machine. We can use the computers and things. But we have this ancient tool that is actually incredibly pro-democratic in terms of its capacity to both generate good political judgments, but also generate anti-oligarchic effects. Okay, and I should say that there's been something of a deliberative wave that's happened, around actually, 2000, around the financial crisis, when it really starts to uptick. If you look at this is just OECD countries, but there's been a kind of significant increase in randomly selected citizens' assemblies that have happened around the OECD in the past decade and a half or so. And so lots of new research is kind of unfolding about these things, but in my sense, it's quite positive. All right, so that's the second one. All right, the third one, agonism. And this is the question of how exactly should we structure conflicts within democratic processes for finance. One of the problems of the deliberative democracy move is the assumption that basically people are all rational actors who, if we get together in a room, they'll have a good deliberation and they'll come up with the best solution, right? That if we can just get people in the room to have a conversation, they will generate the best solution. But in some ways, it's kind of based on kind of somewhat liberal assumption about people's rationality. That kind of detaches them from their interests based on their social position, right? And we know, of course, that we live in a world that is riven with different interests based on different types of social position and groupings. So one of the things that's come out of political theory past couple decades is an important reassessment in some ways of Machiavelli, which you guys know who that is. His politics. And here we see thinkers like political theorist John P. McCormack's book, Machiavellian Democracy, but we also can find books like Camila Verga's Systemic Corruption as another. And one of the key insights from all this is the need. This was kind of Machiavelli's key insight was that if you look at the Roman Empire, the plebeians in some ways were systematically excluded from political participation. And there was a period of inclusion through class-based institutions, right? There was inclusion through the creation of political institutions which were plebeian, right? And Machiavelli's point is basically to say that this was an important way of creating stability and creating growth of the Roman Empire in different ways. We can think about this with respect to finance in the sense that if we're gonna develop a plan for democracy, there needs to be a way in which we can actually structure conflicts within that plan, right? As opposed to papering them over. And the idea here is basically the inclusion of different class-based or issue-based commissions that we can think about incorporating into a plan for democratic finance. All right, so these are the three principles. There's a fourth one in the book, but I didn't have enough time, and so I excluded the fourth one. But these are the three principles. Now I want to show you a graph that you're going to find so shocking and so hard to read, so you shouldn't even try. So how might we put this into a democratic plan for finance? This is what I'm trying to do with this, admittedly very messy thing. So all right, let's just take a bank, okay? Let's just take a bank. But we can think about this for pension funds, other types of funds as well. But let's just take a bank. Yeah, this is very simplified, but this is basically what a bank is, right? It's like you've got the board and you've got its operational divisions. The board is hiring and managing these different operational divisions of the bank, right? That's basically what a bank is. But how do we imbue this thing with democratic life? Because this is an ossified bureaucratic beast, which is driven solely by profit, the profit drive. How do we imbue this with democratic life? Well, if we applied the affected interest principle, we might create a people's assembly that issues mandates for the bank, right? In terms of its portfolio, its total investment portfolio, its total package of loan programs, its total package of services that it offers, right? A group of people that are from, let's say, the Bay Area, who are selected at random to sit on this board, to participate for 3 months out of the year, to generate sort of a set of mandates for the next certain amount of time. Let's say 5 years, right? That the board would be sort of required to follow, right? In sort of creating its own portfolio, right? You might say, this is crazy, McCarthy, get out of here. Well, this is precisely how the Banco Popular in Costa Rica is run. They have an assembly process which selects from different occupations in Costa Rica, which then creates mandates for the bank in terms of the services that it offers. That's a retail bank, it's not an investment bank. So that's one, if we applied that affected interest principle. Similarly, if we applied the lot principle, we would be selecting at random, right? These aren't people that are elected. These aren't experts. These are ordinary residents. Ordinary residents who don't have to pass some certain test to be there. They don't. Age is the only test. They're ordinary residents, non-expert, who are asked to come and learn and become expert in a way. Not like they went to University of Pennsylvania and got a banking degree, but they're becoming expert on the needs of the communities that they live in, and therefore make recommendations about that. They don't need to be experts on how to do like different loans. That's what this is for, right? They're there to issue mandates. Like, you make this happen, banking experts. We just know that we need more housing, right? You make this happen. Okay. Finally, the agonism principle. If we were to put this in motion, we might create, and I won't talk about all this because this is, admitted, it's unruly, and I apologize. We might create different working class or issue-based commissions that review the mandates that are laid out for our bank and have veto power, right? So maybe we live somewhere where we think green policy is really important, or we live somewhere where the labor movement really needs to be represented in this. Well, they can review the mandates and be like, well, this is actually violating like certain pro-labor policy that we're trying to pursue. We don't want this. Or maybe they say this is gonna turn us around 20 years on all the gains that we've made in green infrastructure. We don't want this, right? So that's where you kind of build in the agonism, a recognition that we live in a society that's divided with different groups of people that have different interests, and some should have representation in some meaningful way. Okay, so I'm wrapping up. Don't worry. So this is the minimalist version. The minimalist version. Let's just try it in one bank. Let's just try it in like a single pension fund. And this is something that there's significant organizing around. This is not not this particular model, but creating a democratic bank, creating a democratic pension fund. There is significant organizing around these things. This is completely realizable. Completely realizable. Maybe this part is like not necessarily, but like the creating a public bank that has certain democratic inputs, completely realizable. All right, and there's significant organizing. Now let's go to the pure utopia. But we can also think about a maximalist version in which we introduce these kinds of democratic processes into all the financial institutions, into all the major financial institutions, so that all of them have representation. Remember, the key thing that I was trying to start out with today is that finance is a democracy problem. Because finance, the way it's currently run, there's no mechanism by which values other than profit seeking can come into the determination of how financial assets are bought, sold, and allocated. Right? There's no mechanism. In fact, our whole legal structure is organized around there not being a mechanism. That's what fiduciary duty is. It's what the prudent person rule is. There's a whole legal structure that says asset managers can't think about anything else, right? And yet that is the fundamental problem. The fundamental problem with our financial system is that they can't. And how do we create mechanisms for that? What if there were mechanisms that were actually extended across the economy? Now, of course, we're entering into the world of crazy utopia. But I think it's one that we should at least be thinking about. I'll end it there.
Mike, thanks for that. Really interesting to hear you present. The question that I have is about how are you thinking? Because I think your argument is that there's something about finance that makes it particularly sensitive to politics. That also opens up this opportunity for democratization. And it's particularly sensitive to politics in a way that I think for you, industrial capitalism, for example, isn't. So I just want to know why, because obviously it's something more than just, maybe what you're going to say is it's just maybe it's just liquidity, the ability of finance to escape democratic control, but is there something more about it? Because otherwise it seems like a lot of the things you're saying about finance are just applicable to capitalism in general. That's just the part I would just like to hear you talk about a little bit more. That's clear.
Yeah. Should I wait? Should I just answer? Yeah. Okay. I don't know if the style was to kick a couple or whatever. Yes, I think that's a really great point in question, and I do think it's actually fundamentally different. And the reason why is because finance, at least the kind I'm talking about, asset manager finance, are situations in which people are managing the wealth of others. It's quite literally the wealth of ordinary working people. Now, of course, people would say, well, no, that's not perfectly accurate because the hyper elite control way more financial assets, right? Yeah, that's true. But ordinary people also control significant amounts of financial assets that are tied into these pension funds, et cetera. And so that's what I think makes them more vulnerable in some ways to democratic demand than, say, traditional workplace organizing. Because you can literally say, I own this. Like, I own this. This is part of my savings. And so I think that's what I see as fundamentally different. And then, I mean, it's also worth saying on this point that there's significant amount of organizing around, let's say, pension funds, for instance, because of this. And what we find when people are given the chance to deliberate over their own assets, when they are given the chance to reflect and sort of become quasi-expert on how their own money is invested, they actually make recommendations that cut against the profit at all costs perspective that asset managers have. So one recent, this was probably like 3 years ago, the largest, was this the Netherlands? Yeah, it was in the Netherlands. The largest retail sector fund in the Netherlands. It's not pennies. It's like a $9 billion fund. Like they had a process by which they randomly selected their beneficiaries. These were both people that are currently paying into the funds and also people that are currently getting paid, so like they're already retired. And they brought them together over, I think it was like a 5-weekend process that happened over several months, where they learned about how the fund was investing. They learned what it was invested in. They learned about how fund investment works, and then at the end, they were given space to make recommendations for how they should invest. Keep in mind, this is already a progressive fund, like in comparison to American funds. Like the Dutch funds are already like, we don't invest in nuclear and bombs and stuff. We don't invest in tobacco. They're already like doing that. But the recommendations were from the beneficiaries were that we actually want it to be more progressive in certain domain. So like environmental domain and in ways that we could invest for housing were the things that really came out, the discussion. Which to me, I mean, it's there's other examples as well. It's just so obvious that most people think about other things than profit when it comes to how they spend their money, right? And if given the chance to democratically deliberate over those things, it'll make those things even more come to the fore, because they're not thinking about as like atomized actors looking at their phone trying to adjust. That was long-winded, but I think the main thing is that these are literally owned, by working class people. That's what I would say is different.
So if we look at systems where you have a lot of input from the community or the public, for example, infrastructure, an example, like US infrastructure costs are much higher if you look at different studies versus Europe, because our input process is so long and we have a much higher cost. And then on the other spectrum, having worked in China during the 90s and seeing the move from communist to a private sector situation where you had a lot of input at the top part, and how they moved, obviously they have the political challenges, but they clearly improved the quality of life for 500 million people, taking them out of poverty with the private sector. How do you wrestle with those two situations? If you do this, you have high infrastructure costs. The U.S. we're paralyzed by it. Communists were, which was inefficient. And then you had this time, let's try with one community bank. And I like the idea of getting rid of our politicians and having an assembly of random people. On the other hand, what happens when that community bank makes bad strategic decisions and all the capital goes to the private sector because people's net worth saying, You know, I always say to union folks, you have pension funds, you want them to grow the S&P whatever, but you also want to, you can't have it both ways. It's hard. How do you wrestle with these few questions?
Yeah, I mean, and I think that is, like, you've raised basically the fundamental challenge to anything related to democratizing finance, because it's the question of the degree of profitability that you need to maintain to reproduce yourself as a entity. And to me, that is, it's fundamentally a political question. It's the degree to which, it's the way in which the public fund is capitalized, or the bank in this case. It's the commitments or the lack of commitments from political entities in distributing money to that in order to reproduce it and give it capital to invest. If it doesn't have these things, it will in some ways have to bend towards profit-oriented investing, right? To survive if you're a public bank, a large one. Now there's ways of thinking about it in which these might just be filling in niches, right? And that maybe less so. So if you have a smaller scale fund, which is saying we're not going to try to challenge large banks, we're not going to try to crowd them out, we're not going to try to enter the terrain of competition on the issues that they're already invested in. We're going to invest in these things that have systematic underinvestment because they're not seen as profitable. There, I think there's a larger survivability case. Like there's for filling in certain niches of the market, which are basically left because they're not seen as profitable. So it's really the question of like how do you move from like the minimalist to the maximalist, and the maximalist would require substantial public support, right? It would require substantial public support in my view. Yeah, on the question of efficiency, I think that's a good one. I really do. I guess in some ways I'm at the point in my life where I'm willing to sacrifice a certain amount of efficiency in order to gain a certain amount of social good. Do you know what I mean? I think the financial sector in the U.S. has just gone fully cost-cutting, efficiency route, and it's come at the cost of all these other things. So that's how I would kind of think about it in some way. Yeah. So.
Do you think it's a function maybe that, like, how the Supreme Court ruled that companies are now individuals and they get that protection, so they have an undue influence over our political system? Because a lot of it could be not solved, but positively improved if, the incentive structures of our politicians were restructured. Versus, who's the biggest PAC, and PACs can have hidden money and all that fun stuff, right? Wouldn't that go a long way in hopefully improving the social good?
Yeah, I think it would, but I think the key thing is that people, and this is in my view, I'm somebody that fundamentally believes in democratic processes, and to me the key problem is that the large institutions, firms, but also other ones like universities, do not have structures in which the people who are most directly affected by those organizations have any systematic say. And that for me is sort of like the fundamental problem with finance. It's individuals investing on behalf of other people, those other people not having any say whatsoever. And just to say, this has actually a completely deep history. This is not something new. Like when this whole asset manager financial system started to get put in place, which happened during World War II and right after, with the establishment of pension funds, right? These were Union One funds, and one of the original demands from labor was we share in the management of these funds, and they were trying to win the funds in terms of like being able to control them. And if you read Taft-Hartley Act, 1947, everybody knows this is an anti-labor bill in all sorts of ways. Well, one of the key provisions of the Taft-Hartley Act was to make it so unions can't control pension funds. right? It was because, and politicians were razor clear about this. They knew that if labor controlled these massive funds, which would grow tremendously in a short period of time, they would have a war chest. That's literally what Senator Byrd said in Congress. This will become a war chest for labor. Private industry will never be able to fight them back, right? So this has been like something that goes back, like to the actual formation of these funds, the fight over who controls them. It's just that politicians and capital won, and worker voice has been systematically excluded. That to me is the fundamental problem, I think.
Thank you for this presentation. So my question is, I know you're bracketing housing, but I wonder what it would mean to both housing as a major source of household wealth among sort of non-elite families, and as a major site of investment decision making, and also arguably as one of the most participatory and democratized sites of investment, whether we believe in that definition of democracy or not. What would it mean to derive either scope conditions from land use, kind of like participatory, which seems much more like a veto power rather than a kind of much more substantive involvement in the decision? So can we derive a different kind of democratic design principles based on what does and doesn't work over the kind of allocation of housing investment and the managing of household wealth? Or can we think through scope conditions of maybe actually some kinds of investment cannot be effectively democratized because they're about producing sort of assets for individuals, or I don't know. I feel, but what would it mean to think through the investment decisions over housing as a basis to think about principles?
Luis?
Yes.
Like the investment decisions of individuals, or in terms of
decisions of developers that then sort of run up against the kind of effort to sort of homeowners who are using zoning and land use regulation to kind of sort of curtail or sort of shape investment decisions, in part because what is being produced is housing wealth as well for potential buyers.
Yeah, for sure. Although housing wealth for a certain class of buyers.
No, of course.
Right?
There's
I think that's, housing is not my area of expertise. So I'll just say that to be completely honest. But one of the, I participated with a number of folks in Jane Family Institute. And we basically were working with Public Bank LA. And they needed basically a series of kind of white papers, short white papers that they could use in political organizing, right? In the city council, what would the public bank do? And we wrote 4 or 5 of them. The one I did was on democratic governance, but we also had one on energy investing, housing, the bank's balance sheet, how you would calculate that, and community wealth. So how might a democratic bank invest in things like co-ops or in developing community wealth in different ways? And one of the sort of the key kind of points of the housing, this is a complicated issue, was that low medium income housing is underinvested in precisely because it's not as profitable, right? And that's one thing that you could start to think about democratic finance doing, basically taking loss or not taking as great of gain in pursuit of social values, right? In pursuit of social values. So that's how I think about it. I think about it in a very simplistic kind of way, frankly. But you are not able to get that out of the existing systems of financial allocation, because they will see a one option being generating greater return than another, and it's an easy choice. It's not even easy. It's literally mandated by law. And so that's what democratic finance could do. It could say this is a social priority. We're willing to incur certain loss or not as great gain because we're in pursuit of a value that's what we see as a higher value in some sense. I don't know if that addressed you, what your question was directly.
Hi, getting back to Occupy and maybe ESG, I wonder about lessons learned what was the distraction for each of those? And maybe to drill into those is like, okay, give me some advice here. David Graeber's debt is on my syllabus. What should I be watching out for? And over at ESG, I'm a metrics man, so why don't we continue to see ESG metrics, even if they're not guiding policy or investments, just so the rest of the world can see and choose between Coke or Pepsi. If you know what I mean.
I've always been a Dr. Pepper guy. This is what I would say about that is, let me see if I can get this right. I'll try to be very brief because this is obviously a lot of text. But one of the things I try to think about in the book is okay, there's been a widespread acknowledgement that finance has gone into deep trouble, and also a widespread type of responses. And the ESG response, I would put into a normative type of response. The basic idea with ESG, environment, social governance, for folks that don't know, is that if we create criteria, metrics that we can assign to a fund, which we can say it's investing in these positive ways, people will have the option to invest in it. If we create things like what is it, the UN responsible investing, I'm forgetting the name. If we create these things that people can sign on to, they can commit themselves to like investing in good green ways, And so it's basically been like a movement to try to change financiers' normative orientation to how they invest. That's how I see ESG. But it's trying to basically work through some kind of moral self-regulation. If we can just get the financiers to just want to do good in the world.
I want to see the outcomes of doing good in the world, not just pronouncements of we invest in this and we expect a miracle to happen and it'll be social good, but reporting on the social goods achieved.
Yeah, exactly. What social goods have been achieved? Like the people that signed on to the UN principles of responsibility. I'm forgetting the name of this thing. We're the ones that bankrolled the Aramco going public. It's all, in my opinion, it's performative, and it actually has not affected the allocation of finance in a significant way. And the degree to which ESG funds did grow over a period of kind of like that moment of liberal hegemony that we had, which is now completely gone, there's now been a retrenchment from those funds, right? As Republican states have kind of moved against them. So my way of thinking is that we can't really change their minds. It's not that we really want to go back to some like post-war moment where we had regulations. We're past that. We're in a completely different political economy. We're not in the post-war labor accord anymore. We really need to think about how do we control these funds. Right? How do we introduce democratic control into these funds? That's how I think about it, at least in my simplistic, crude way.
If you accept the premise that we're in something far worse than the dot-com bubble with respect to the stock market, US stock buybacks, passive investment strategies, AI hype, what do you think the catalyst is for it finally crashing, and what happens to all the pension fund solvency, 401ks, et cetera, when it finally does?
If I knew the answer to that, I would be just like accumulating my money into a certain things. I have no idea. I have no idea what's going to cause the fundamental crash. Yeah, that's a great question, and one that I literally have no idea in terms of the answer of. What do you think? I'll put you on the spot.
We realize AI has been overhyped.
Yeah. Yeah, I know. But I feel like we're kind of, I mean, we were just saying this before. We're kind of in this, like, maybe it's not being overhyped moment, right? We'll see. We'll see. We'll see.
I was going to say something about AI. Different, actually, the opposite scenario. So I was going to say, I like your plan, but maybe not for the reasons that you laid out. The reason is that since AI will take all our jobs, we might as well all occupy ourselves with politics, and but it was just a joke. But anyway.
I mean, I like it. I like it as an idea. Yeah.
But my question is, the pension funds are really central to this whole story.
Yeah.
And so my question is this a finance problem or is this a pension fund problem? In other words, is there another way to design pension systems that would actually avoid giving so much power to the financial sector?
Mm-hmm.
Maybe the solution is actually not controlling the pension funds, but designing the pension system differently. I mean, I'm thinking about the French system, for instance, even though the demography is against us right now. But if it's the current if it's the current active population that's sort of paying for the pension of the people who are retired right now, you don't have this enormous accumulation of sort of wealth in the pension system.
Basically, you're suggesting, why don't we just make it like everything like Social Security, in a way?
Basically.
Yeah, I think that's interesting, but I mean, it's funny. Like on your first point about about let's just do politics. There's an idea in the book which is called Democracy Fridays. This is in the maximalist version, where we just make a day out of the week set aside for all political engagement, where we go serve on our mini public, and one day of the week it's paid. And in some ways, I find this very very exciting. But in terms of the pension issue. I think that, well, I guess I have two ways of responding to your point. One is, like, in an ideal world, I completely agree. Let's get rid of private pensions. All they do is create, like, inequality. All they do is sort of deepen the after work inequality that exists within not just the working class but across the whole society. Why don't we just have one standard public pension that is guaranteed, a fixed rate, everybody gets the exact same amount? I totally agree with you. But I also like class struggle stuff. And I like the class struggle stuff. And we have these large pensions. And I do think, that Democratic senator from the South, Byrd, was right, that they could be a kind of war chest in a way, that they could actually be a way for labor to exert different sorts of power. Not necessarily like breaking up capital or something, but in the sense of being able to invest and sort of create positive projects in the world through sort of labor's control over its own funds. And so that's why I hold on to our unequal American system. That, like, I think in some ways even though the funds have been created and generate negative outcomes in some ways, we have to keep in mind, by the mid-1970s, American pension funds, overwhelmingly these are union, controlled 25% of all US corporate equities. 25%. It's a pretty significant amount, right? And the size is just, it's tremendous how big these things are. And so that's, from a practical political perspective, I think that there's something to be gained from democratizing them. But I think you're right, that a better system would be to have not have any.
So Mike, we agree on a lot, but let me be a little bit contentious. Is your argument basically an argument for democratizing finance, or is it an argument for democratizing philanthropy? That is to say, a pension is a kind of a hybrid thing because it is collectively raised as capital and should serve some kind of public purpose. But, there's a powerful argument for saying that a philanthropist who is nominally disaccumulating wealth rather than accumulating it for some public good should have the tax advantages for the rest of what is being accumulated offset by the fact that the people to be affected should, perhaps randomly using your method or by lot, should have a voice in the grant giving practice. But you've described essentially investment of assets under the general rubric of a grant giving process that should be controlled by those who are affected. The thing that is left out when you're talking about philanthropy, which is very tax advantaged, is that it is an instrument for doing the other thing, which involves two concepts that are essential to philanthropy, which is that you give up leverage, and the goal is not accumulation. In finance, leverage and accumulation are fundamental to what distinguishes it from philanthropy. Is your argument for the democratization of finance essentially that it should be seen as a form of philanthropy?
Yeah, that is that's a good question. I think it comes down to what you think democracy would do. Because it's quite possible that you get the people of a pension fund together and you open up that fund to deliberative processes, and you introduce a menu of possible options about like the investment portfolio of the fund. You kind of weigh that against other options, weighing different kinds of return expectations and all that. And they might go, actually, why aren't we invested in nuclear? Why aren't we invested in tobacco? We could be actually getting more out of our fund, right? Like I'm making some assumptions about what democracy will do. Democracy might actually make funds less philanthropic, if right. It just depends on the outcome of the process. That being said, I do think that there are examples when you have basically subject these funds to these different processes where the recommendation, and oftentimes it's just a recommendation, like what happened in the Netherlands with their retail sector fund, was non-binding. It was just like let's see what the members think. People do recommend more progressive use of funds, i.e. more philanthropic. So if that is the outcome, then I would say, yeah, maybe that is what I'm arguing. Although that being said, I wouldn't say it's entirely philanthropic in the sense that let's say the example of the retail sector fund in the Netherlands who did this internal process. The members themselves viewed living in a world that's environmentally sustainable, living in communities that there was affordable housing, as part of what they saw a good life for themselves was. Right? They weren't simply saying, I'm trying to help other people out in the philanthropic kind of like giving my money to you. They had a wider scope of things in their brains about what it means to get a good return on an investment. Right? Like they didn't just see return on investment in terms of like financial return. They also saw it as social return. Like I'm investing, and this is actually, I want to live in a place that doesn't have a lot of crime. That makes me happy. I want to live in a place that is nice to walk around in. So that's why I would say it's maybe not entirely philanthropic. Like you can see this as a self-interest. Like people investing in ways in which they're generating non-financial goods, but they nonetheless see that as part of their interest, right? They see that as part of making a good life for them. But yeah, that's how I would think about it.
So I'm very sorry to have to bring this Finance and Democracy Monday to a close, but thank you very much for this wonderful presentation. I would remind everyone that Fabian Muniesa will be giving a talk at the same time, same place on Thursday at 4 p.m. If you're interested in finding out more, besi.berkeley.edu, click on Finance and Democracy, or send me an email at bjudge@berkeley.edu. Thank you all so much for being here, and I look forward to continuing the conversation. And there'll be a reception following Fabian's talk on Thursday here. Thank you all so much.